This is Ralph Sass, and this is Accounting 211. It is Chapter 2 and Part 2 of the lecture. And once again, this will last about 15 minutes. Where I left off is we were going through some transactions and how they impact the balance sheet. And here on this 27th, they made a partial payment of $6,800 on their account payable. So cash is going to go down by $6,800, and their accounts payable is going to go down by $6,800. And notice that also means that my assets are going to go down by $6,800. Why? Because my cash went down, and my liabilities plus owner's equity are going to go down by 6,800. And notice my assets still equal my liabilities plus my owner's equity. This is the first one that had the transaction for revenue or expenses. Right now, they do something interesting with it. Let's kind of take a look at this transaction. They received $2,200 in cash for some repair services. So their cash is going to go up by $2,200, and the retained earnings are going to go up by $2,200. In reality, this would show up on the income statement as revenue. The thing to realize is that all revenue goes right to the owner's equity section. All expenses come right out of the owner's equity section. That also goes to explain why owners of small businesses are so concerned about expenses, because that works to reduce their owner's equity in a business, basically directly and immediately. We're going to find out how this works over the next couple of chapters. For right now, we're just looking at how it impacts the balance sheet, and what happens is any revenue is going to show up right there in retained earnings. Now notice here they paid $1,400 in cash for expenses, probably things like gas, whatever. Their cash went down by $1,400. Notice their retained earnings went down by $1,400. Notice assets still equal liabilities and owner's equity. So notice what happens. Revenue increases retained earnings. Expenses reduce retained earnings. Okay, so the income statement is really working right here through that retained earnings portion of the owner's equity section of the balance sheet. If we put all those transactions on a sheet that looks like this, a spreadsheet, notice I've got assets on the left-hand side. I've got it that it equals my liabilities plus owner's equity. What they've done is taken each transaction and recorded exactly what happened to each of those particular items. A couple of quick notes here. Everything that impacted the cash account is going to show up in the statement of cash flows. So the statement of cash flows is going to explain all of those items right there. Okay. What's going to show up on the income statement are those two items that impacted retained earnings, which are down here. That's going to be my income statement. Okay. And all of these items along the bottom are what's going to show up in my balance sheet. That's all going to show up in my balance sheet. So all those items there are going to show up in my balance sheet. Okay, so that's where the statement of cash flows, the income statement, and the balance sheet items are coming to fruition. Quick note about these accounts up here at the top. Those are the equivalent to my buckets that I mentioned in lecture 1. Okay, I've got a bucket that says cash, and I'm just recording everything that happened in cash. I've got a bucket called accounts receivable, and that's everything that happened in that bucket accounts receivable. I've got a bucket called building, and that's everything that happened in that bucket called building. So those are my buckets that relates to what I talked about in chapter 2 and chapter 1 for that matter earlier in the semester. Already mentioned that those statements on the far left are the statements that impact the statement of cash flows, and those items on the right are the items that are going to be on the income statement. Okay, and notice what they had here. Let me go back quick. Yep. They didn't do a great job explaining the different operating expenses, and that's okay. Notice if we put together their income statement, we name of the company, income statement, and notice it says for the period. Okay, why? Because it's a movie. It's covering the period from January 20th to January 31st. Okay, my revenue was $2,200. My expenses were a total of $1,400 for those two, and my net income was $800. Note, and this is important, and I can't stress this enough, investments by the owner and payments to the owners, dividends, whatever, are not included in the income statement. So when they made that $80,000 initial investment, was that included in the income statement? And the answer is no. Statement of cash flows, and unfortunately, I mean, I'm going to talk about it a couple of times of the semester, but this is probably one of the few times where we're going to talk about these items. Notice, once again, name of the company, statement of cash flows, period of time for the period ended. Critical. When I ask you to do these on an exam, what have you, you're going to need to include those three items. There are three parts to a cash flow statement. There's a cash flow from operating activities, and that's the amount from running your business. And notice the amount of revenue, or the amount of cash, pardon me, from running the business was $800. We're going to take the next portion, and all statement of cash flows have these three sections. The next section is investing activities, and that's buying or selling assets. So everything every time they bought or sold an asset, it's going to show up there, and that's going to show up under investing activities. And then financing activities is stock and bond transactions, and that's the third section. Every statement of cash flows has these three sections, and that's the 80 grand. And notice what this is telling me. This is telling me at the beginning, I started with no cash. I added during those 11 days $16,600 in cash. So what's my cash balance at the end of the period of time on January 31st? It is $16,600. So key point here, statement of cash flows is a period. All the statement of cash flows have three portions. Operating activities, net is coming from your sales, your revenue and expense transactions. Investing activities is buying and selling assets, and financing activities is selling stock, selling bonds, or paying off bonds or notes. So operating activities include the cash effects of revenue and expense transactions. Already mentioned that. Investing activities include the cash effects of purchasing and selling assets, buying and selling assets. And finally, financing activities include the cash effects of transactions with owners and creditors, selling stock, borrowing money, paying the bank back money you already borrowed. Those are going to show up under statement of cash flows. I already mentioned that those items down there at the bottom are what's going to show up on the balance sheet. And notice the balance sheet is here, and all they did is copied those numbers at the bottom, 16.8, 1,200, what have you. There's the 16.8, 16.6, 1,200, 12 grand. Let me just see, it was 16.6. And notice my assets equal my liabilities plus owner's equity. So all I did is copied those amounts from that earlier statement onto these. There is a very strong relationship between the statements. Okay, the balance sheet is on a particular date. Balance sheet is on a particular date, so we have those two time periods, and then the income statement and the statement of cash flows explains what happened between those two dates. The statement of cash flows explains what happened to cash, okay, and the income statement explains what happened to the owner's equity portion of the balance sheet. So the balance sheets are pictures on a particular time, and the income statement and statement of cash flows are movies. We call this, the fancy name for it is articulation, okay? And notice that ending cash value there becomes the cash that shows up on our balance sheet there, and our net income here becomes what shows up in our statement of retained earnings down here. The balance sheet, the income statement, and statement of cash flows all fit together, okay? They don't stand alone, but they all fit together. There are some other things that go with these financial statements. If you ever took a look at one online or whatever, and you can go to SEC.gov and look at the Edgar database, and you can pull them up for Walmart and Lowe's and what have you. There is some information that goes with it. It's called the notes to the financial statements, and generally things like this will be included in some of those notes to the financial statements and or management's discussion. They'll almost always have some sort of management discussion and interpretation. They'll have some disclosures, perhaps some notes. Industry, competitors, and national economy, they may or may not have, but you need to consider those items when evaluating the financial statements. The three major forms of business organizations are sole proprietorships, partnerships, and corporations. Not going to spend any time going over the benefits or disadvantages of any of those. But I do want to mention how it would show up in the owner's equity section. If it is a sole proprietorship, it will have the owner. It'll say owner's equity, and it'll say the name of the name of the person, their capital, and in this case, 80,800. Okay. If it is a partnership that's between two or more people, it'll say the partner's equity. It'll list each partner. In this case, there were two partners. They split it equally. Okay, so they each have 40,400. There is no requirement that it needs to be split equally, but it can be. It depends upon the articles of partnership. And the total partner's equity in this case was 80,800. And if it's a corporation, its owner's equity section will have a capital stock, and that'll be the initial investment of the owners, and then the retained earnings, which will be the sum of all the prior year's profits and losses. In this case, it's 800, and it's 80,800. Point is by looking at the owner's equity section of a balance sheet, you can tell exactly what type of a corporation, a company it is, how it is set up. There are two concerns of all outside users. One is liquidity, the second is profitability. Talking about liquidity first. Liquidity is, do you have enough cash to pay your bills? You can be profitable, but the companies haven't paid you yet, so you don't have enough cash to pay your bills. There are companies that have filed for bankruptcy because even though they were profitable, because they didn't have the cash to pay their bills. So liquidity is, do you have the cash to pay your bills? Profitability is, are you making a profit? What does your income statement say? Do you have net income? Already mentioned that there are notes that go to the financial statements, and they often provide necessary facts for the interpretation of the statements. They will include things such as depreciation assumptions, inventory assumptions, perhaps accounts receivable assumptions. They'll tell you a lot of the assumptions that were used in preparing the income statement, the balance sheet, or the statement of cash flows. It is critical that you read those along with the balance sheet, the income statement, and the statement of cash flows. I cannot stress that enough. We're not going to spend time worrying about how to write those or what have you in this class, but it is important to read and interpret those as well. Okay. Creditors are going to look for strong financial statements. Window dressing is perfectly acceptable. It occurs when management takes measures to make the company appear as strong as possible in its financial statements. It's basically perhaps paying off bills or not paying off bills to make it look like your bills are less than they are or what have you. It is perfectly legal to window dress. The same way it's perfectly legal to put on your finest clothes to go out for that interview so you look your best and what have you. That's what window dressing is. And can companies and do companies make their financial statements look as positive as possible? And the answer is yes. Is there anything wrong with that? And the answer is no. That concludes chapter 2. If you have any questions, please feel free to let me know and let me know if you have any questions. Thank you.